Both Alphabet and Facebook hit 52-week highs during trading yesterday, but check out the other big tech names. While Microsoft has outperformed the S&P so far this year, Amazon and Apple have been laggards. So how should you be positioning your tech portfolio ahead of and after today's Fed announcement? Joining us now, Gene Munster, Loop Ventures founder and managing partner, to help us out. Hey, Gene, good to see you. It's interesting we frame the tech discussion as a corollary to the Fed decision and the Fed debate, but that's a necessary thing because this group in general has in part traded based on what yields are doing, whether we're going to have inflation under control or not. Is the macro more important than the micro at the moment for big tech?
For the near term, I think that the macro is more important. I think that I'm eagerly anticipating what the Fed's going to say today. A year ago, I didn't really pay much attention to what the Fed said, so I think that that is absolutely true. Going from an uber dovish to a dovish position probably is going to suggest that rates go higher, which I think, again, in the near term, investors in not only the four that we're talking about here, but broader tech should be cautious about that. But I do want to draw a very clear line between the near term and the long term and the fundamentals. And I think that what you have seen with the trade with Google and Facebook doing well, that is partially inflationary because those two businesses tend to do exceptionally well when prices go up. It's a highly leveraged model. But on the other side, Apple and Amazon, I think that this is kind of shifting to the long term. I think they're really going to surprise investors in the back half of the year. I suspect that you're going to see a reversion and that performance is going to start to come from Apple and Amazon. And what it ultimately comes down to is performance. And I think that just this accelerating digital transformation that's impacting both Amazon and Apple, I think is going to benefit the fundamentals. And so, Mike, the way I think about it is I'm watching this. I'm bracing for the worst in terms of what happens with these stocks, but I'm optimistic about where it's going longer term.
You know, it's interesting that we now have gotten so entrenched in this idea that higher yields, you know, is a trigger to sell the big tech stocks in general, the big growth stocks. But if you go back to 2013, everyone talks about the taper tantrum as if it was some kind of cataclysmic, disastrous thing. It's like a 6% pullback in the S&P. Tech did really well after that, right? I mean, you go into that next year, and that was really the birth of FANG, where, you know, Jim Cramer comes up with FANG not long after that and nails it. So, I mean, do we have to be stuck in this kind of rubric for a long period of time?
I think we're going to be stuck into it for, I think, until the fall, you know, as we have these monthly updates and commentary from the Fed. Ultimately, what's going to happen is I suspect that rates are going to go up. The Fed's going to talk about rates going up, whether it's 2023. And I think that's the point where there probably is some concern. I bet there's trade-off in these tech names. And then I think it's essentially priced in because, as we know, that the market is a great anticipatory. And I think once we start to see actually real evidence, hard evidence from the Fed that rates are going up, I think investors are going to actually breathe, tech investors, a sigh of relief and say, finally, we can start talking about the fundamentals again and not be worried about commentary about the yield curve. And so at the end of the day, I think what's most important to ask is, how are our lives changing in the decades to come and which companies are going to benefit? And I think that that conversation outweighs any talk about what's going to happen with interest rates.
You mentioned Facebook and Alphabet being levered to kind of this reopening type move, travel, advertising demand going up, really tracks GDP pretty well. Apple and Amazon really have been just consolidating massive moves into last summer, right? I mean, in terms of their stocks and maybe their fundamentals. But what do you think changes in the latter part of this year that brings investors back to those types of names, Amazon and Apple?
I think it's just performance. I've covered Apple for a long time, and just maybe focusing on that. The March quarter was spectacular. It was difficult to come up with the right adjectives. Maybe my perspective, the best quarter in 10 years, the best outperformance in a decade for the company, and yet the stock has been flat. And I think what that is representative of is a belief from investors that the best has happened, that they've just pulled forward this massive amount of demand. And ultimately, as we look forward, we're going to start to see declining revenue growth. I think that's what effectively has happened. And the commentary is somewhat similar around Amazon. So to answer your question is, what gets it out of this kind of this flattish piece they're in? It's just simply performance.
Shepard Smith here. Thanks for watching CNBC on YouTube.